Welcome to RBC's Markets in Motion podcast, recorded February 9th, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, we run through our thoughts on last week's choppy price action in the S&P 500 and reiterate our 77.50 12-month forward S&P 500 price target. Second, we update the stats we're tracking for 4Q25 reporting season, which generally bounced back in our latest update but remain weaker than what we've seen in past reporting seasons. If you'd like to hear more, here's another 5 minutes. Let's start with takeaway number 1, thoughts on a choppy week. After rallying back on Friday, the S&P 500 ended the week close to flat. But before Friday's recovery, the index was down 2.6% from its latest all-time high. While it wasn't pleasant, the week didn't alter our view on the path for stocks in the year ahead. We have been here before and not too long ago. We've had 4 similar 2.4 to 3% drawdown in peak over the last 6 to 7 months in this index. There was one drawdown that was a bit worse, the one ending November 20th, 2025, that represented a total decline of 5.1% from peak, but admittedly felt much worse at the time. It is possible that this latest bout of weakness has played out for now. But if there's more pain to come, we think it's reasonable to anticipate a Tier 1 garden variety pullback in the 5 to 10% range. As we highlight in our 4 tiers of fear framework in the post-GFC era, serious drawdowns that have exceeded the 5 to 10% range have tended to be growth scares, when fears of a systemic issue or recession surface, similar to the environment seen a year ago when the S&P 500 fell 18.9% around the Liberation Day tariff announcement. While we take concerns about the AI trade in private markets and other matters seriously, we think it's premature to assume that's the kind of risk we face today. Heading into last week, a few of the indicators we track were signaling a potential short-term problem. As we've discussed the sell-off over the past week, we found ourselves referring to a few different charts that we track regularly. The first one of these highlights how Bitcoin and an index of private market-related stocks, as well as other risk or sentiment indicators, turned lower right before or right around when the S&P 500 experienced its 5.1% drawdown last fall. And some of these had been also showing signs of weakness in early 2026, generating some concern in our minds about a looming bout of risk aversion. The second chart, the 2 versions of the Russell 2000 forward PE that we track had both returned to levels in line with or very close to their November 2024 highs, which was their most recent major peaks. This was interesting to us for a few reasons. One of these PEs, specifically the FY2 PE, had helped mark the bottom in stocks in April 2025 when it returned to typical recession lows. Additionally, small caps have been one of the primary expressions in U.S. equity markets of late of the rotation trade. And the third chart, stock market optimism slipped a bit after returning to levels close to most past peaks in the latest Conference Board Consumer Confidence Survey. To us, this was a potential sign of fading froth among the much discussed but difficult to track retail investors who have been viewed as being a strong underpinning of stock market performance in the past year. So looking ahead, our models still argue for solid gains in the stock market over the next 12 months. With February underway, last week we completed our pre-planned monthly refresh of the math behind our 12-month forward S&P 500 price target. After running through this exercise, we are sticking with 77.50 and note that there were no significant changes in signal from the 5 models that we used to arrive at this forecast since we last updated them in early January. Our sentiment model, which is elevated but not euphoric, points to a 9% gain. Our valuation and earnings test plus our earnings yield gap analysis both point to strong gains going forward. Finally, our Fed and GDP tests point to solid 12-month forward gains of 13% and 10% respectively if the Fed cuts a few more times and real GDP ends the year in the 2.1 to 3% range. Both are in line with current consensus estimates, and the latter, the GDP stats, have been moving up. Moving on to takeaway number 2, 4Q25 earnings stats still look a little softer than we'd like, but we did see some firming last week. In our last podcast, we noted that the stats around 4Q25 reporting season were looking a little squishy, something we think also contributed to the weakness in the stock market that occurred last week. In our latest update, the stats still aren't as strong as they've been in the past, but they did firm up a bit, which may have also contributed to Friday's bounce back. Here are some of the highlights. First off, if you look at the EPS beat rate for the S&P 500, it did stabilize last week, though it is still lagging behind 3Q25 reporting season. As of the latest update, the percent of companies beating consensus on earnings was tracking at 78%, up a little bit from our previous update of 77%, but still below the 82% rate from 3Q25. The Russell 2000, by contrast, continues to show improvement on this stat versus last quarter. Meanwhile, the rate of upward EPS estimate revisions for the S&P 500 did move up last week, though it also remains below last September's high. In our latest update, our favorite gauge of earnings sentiment, the rate of upward EPS estimate revisions has rebounded back to 54%. That's up from 51% in our prior update. Despite the improvement, that stat is still well below the rate of upward EPS estimate revisions seen in early September of 65%. On sectors, the thing that jumped out to us the most last week was that S&P 500 tech, while still seeing mostly upward revisions, has seen a bit of a deceleration after returning to levels nearly back in line with past peaks. This modest fall from grace reverberated strongly in stock prices, however, and the reaction in prices speaks to how high the bar had risen. Also of note, the Russell 2000 has seen a slightly higher rate of upward EPS estimate revisions than the S&P 500. The Russell is now at 55.7, indicating that the S&P 500 has lost some dominance from this perspective. And finally, on the earnings stats, outright improvement in the most important stat was seen. Even with all of these issues, the bottom-up consensus EPS forecast for the S&P 500 in 2026 is now rounding up to 314, back on track to 13% growth on the year. Earlier in reporting season, this stat had slipped a little below 313. And wrapping up with just one final earnings-related note, our team did continue to read through S&P 500 earnings call transcripts last week looking for macro takeaways and breadcrumbs. Key themes were pretty similar to prior weeks. They included a cautiously optimistic and mixed overall outlook with a bit less focus on geopolitics, a cautious yet resilient consumer with no real changes in overall narrative that we picked up on at least, ongoing tariff talk with pricing, mitigation, and manageability in focus, along with the idea that impacts could lessen later this year. From a generalist perspective, the AI discussion was also more of the same, as AI was described as an enabler of transformation with an emphasis on creating efficiency and productivity improvements, fostering innovation, enhancing customer and employee experiences, and controlling costs. Data centers and CapEx were still in focus. We noticed more emphasis on brand enhancement, agentic AI capabilities, and competitive moats and proprietary data last week than in the past, but this may just be a function of us paying attention more to those details. Stock price reactions, which hit both the disruptors and the disrupted, suggested to us that the bar may simply have been too high heading in for this trade, and that the AI jitters we've seen in the investment community since August simply needed to be realized with some overall de-risking taking place. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.